China will be coming into the spotlight more and more because of their economic woes, as we believe their crisis accelerates into 2026. So you're going to hear more about China. The Fed at some point is going to realize that they're really behind the curve, so there'll be some sort of spectacular, over the weekend meeting and emergency rate cuts at some point in 2026. And then finally, I think the AI bubble may have popped, but I suspect, and unfortunately for Trump and the administration, they're going to try to continue to prop that up with some sort of government, whether it's equity investment or some sort of aid to the AI companies. That might give one more blow off top to the AI companies, but if that happens, you can short the hell out of everything. It's over after the massive pop.
You're watching Capital Cosm. My name is Danny. It is December 4th, 2025, and my guest today is Ed Dowd, a huge fan favorite who we're excited to have on the show. Ed, thank you so much for coming on.
Thanks for having me on again, Danny. Good to be here, and I love your jacket.
Oh, well, thank you. I had to wear it for the occasion. I mean, you're a pretty hip guy, so I've got to look the part. But guys, before we continue on, I'd like to remind you to hit that like and subscribe if you're getting value out of these videos, or if you do get value out of this video later on. Remember to hit that like and subscribe. It really does go a long way in helping support the channel, and it's free. And so that aside, Ed, let's just dive right in here. Let's go ahead and kick it off with the Japanese carry trade story. The Japanese 10-year right now, at the time of this recording, up 2%, currently trading at 1.93%. The 30-year at 3.39%. What's going on with the Japanese carry trade? Is this a cause for concern, not just for Japan, but for the global economy, the world?
Yeah. So I don't know if maybe you remember, you probably do because you're super involved in the financial markets. Last August in 2024, there was a yen carry trade scare. And the bond markets are telling you that interest rates need to be raised. The problem is on the short end, if you raise the short-term interest rate, it has the potential to blow up the yen carry trade, which has been in effect for decades. It was classic. You borrow in yen, it's effectively zero, and you buy other assets, and then you hedge away the currency risk. This raising interest rates on the short end make that much more unprofitable, and maybe put some people in losing positions, which then creates potential for a giant margin call. So the Japanese government is in a kind of this Hobbesian decision-making process. They have a decision. They have runaway inflation after decades of zero interest rates where there was no inflation, but now there's inflation. And they have a choice. And their economy isn't doing well, and they have to figure out a way to defend their currency. So they either raise interest rates to save their currency, or they don't, to save the yen carry trade. And Japan has been a big component of the global monetary system since before the Great Financial Crisis and after the Great Financial Crisis. There was a lot of coordination between central banks, the U.S., the ECB, and the Bank of Japan. And there would be after the Great Financial Crisis, there was a lot of scares. And what became apparent, they needed to keep printing and doing quantitative easing, and one central bank would hand it off to the next. So there was kind of this coordinated, the U.S. would do QE for a while, they'd stop, then the ECB would do it, then the Bank of Japan would do it, and you could see the coordination going on. So the Bank of Japan may be in trouble. I'm not going to call the end of the yen carry trade, because they're going to try everything they can to intervene and try to paper this over. They may open up more dollar swap lines with the U.S. Who knows what's going to happen behind the scenes? But the Bank of Japan's minister came out and said that the yen is not trading on fundamentals, and that was code for they're not, the market's no longer paying attention to our interventions. So basically what she's admitting is that the market forces are overwhelming their intervention efforts. So this this is a dangerous situation. And it also happens to be timed with what we're calling for an economic recession in the US and also globally. China's in trouble. We put out a big report recently that China is going to the acute phase of their economic crisis in real estate, which will affect a lot of other industries because their construction industry has been held up by long-lived projects which are rolling off, even though their real estate market started getting into trouble in 2020. So it's all kind of coming to a head in 2026. The Biden illegal immigration, which floated our economy, has been halted. Deportations aren't that many. Self-deportations are higher, but we kind of have this, perfect storm brewing, and the Bank of Japan certainly doesn't help the situation at all.
What does a crisis in China mean for the rest of the world?
Well, what it means is they need to export more. And so that's why we're having trade wars and tariffs. They've been growing at about 5% GDP in yuan. And to get 5%, they've been printing, extending credit. And a lot of that credit's going into industries that are exporting. And so their internal consumption hit a wall in 2020 with their demographic decline. And ever since then, their GDP is 5% isn't enough to really, keep people happy in China. 5% just keeps the lights on. So in order for them to grow at 5%, they need to export more. And as the U.S. runs into problems, and with the tariff wars, there's starting to be this feedback loop. And so China getting into trouble really hurts our Asian trading partners like Japan, South Korea. There's a crisis brewing there as their economic activity slows. So, and we're seeing, dollar liquidity becoming a problem. I think the dollar is in the process of bottoming. Cycle-wise, we think we hit a 4-year cycle low. We're just waiting for the dollar to kind of start really getting bid. There's a dollar liquidity shortage out there, and it's going to become more apparent as we roll through time. So this is China, the U.S., Japan, and Europe is a disaster. It's all kind of coming to a head. And it says to us that a big risk-off trade is coming. And that's why we've been recommending people have like dry powder in their portfolio, and or if they're more speculative, buy U.S. Treasuries out along the yield curve, because the interest rates, we think, are going to go a lot lower. And since we issued our report in January, the 10-year was at 4.80. It's now flirting with 4%, wanting to go lower. And the other thing that people need to just watch the 3-month T-bill in the U.S. That went to a new 52-week low a couple days ago. In my humble opinion, the Fed is behind the curve, and they'll be catching up soon enough once it becomes apparent what's going on. I also want to note there's this lack of economic data due to the government shutdown, which is very ill-timed, and it's not good for the capital markets. So the capital markets are now going to start looking for other sources of information. Also, interesting to note, I just learned this week that China has decided to stop reporting new home sales. So the China report we put out was tracking new home sales, and obviously that data won't be available going forward. So there's a reason China's hiding that data. It's getting worse.
So I pulled up the 3-year bond yield. Walk us through what are some of the key insights that you mentioned here. What are we supposed to be looking at?
That's the 3-month T-bill, not the
3-month. Oh, my bad. Well, yeah. In that case, let me go ahead and pull that up here while we talk about Japan. You mentioned Japan being in a predicament where they might have to sacrifice the currency to maintain the carry trade unwind. What does that mean? Does that mean that they would monetize the debt? They'd have to effectively print the money that they would need to buy up their own debt. And if you had a dollar, go ahead.
Yeah, you don't want a currency crisis. You don't want the currency to devalue beyond your control. It just causes mayhem. So the U.S. dollar yen is the line in the sand is 160, and if we start going above that, there's a currency crisis in Japan, which will unleash chaos. So they need to defend that, but then that also will potentially unwind the yen carry trade. So we're kind of at this Japan has to make a decision: save the world or save themselves. And if I'm the Bank of Japan, I'd save myself. But the U.S. has a lot of influence over Japan. I think a lot of people don't understand. After World War II, this is not a popular opinion, but a lot of these countries became vassal states, and our influence is such that we can tell a lot of these countries what to do. And I think a lot of Japan's monetary policy has been influenced by the U.S.
I see. So I was able to pull up the 3-month bond yield, and this is what we got here. We're currently at 3.7% on the 3-month bond yield.
Correct.
10-year, for example, for reference, is around 4.1% on the 10-year yield.
Yep.
There doesn't seem to be much delta between the two, but go ahead and walk us through what are some of the key takeaways that you were alluding to here.
Look at the chart. Go out to the longer term chart. Go to where you were before. It shows the cycles. Notice the Fed. There's an easy monetary policy usually. Then there's an economic overheating situation. Then the Fed raises interest rates. There's a plateau in interest rates. And the Fed usually always is late to the party to lower interest rates. And, they took away the punch bowl. Usually some sort of, fraud is exposed. In the 90s, it was the S&L crisis. Then there was the dot-com crisis. Then there was the banking crisis. And notice every time they start, after a pause in interest rate hike cycle, then there's a lowering of the interest rates. That's when the recession and the credit destruction really hits. And that's where we are, right in the beginning. People are celebrating Fed rate cuts as if they're a good thing. That is not normally the case in this part of the cycle after a tremendous hike in interest rates. So we're in the credit deterioration part of the cycle. We started seeing that in the fall with private credit being called into question, which I think is the new subprime. There was an article that came out yesterday that said, some of the officials in officialdom are saying private credit defaults may rise, but it's going to be okay. It's not okay because there's always a contagion effect and there's feedback loops and credit tightens, and we're in a credit destruction phase where things are going to go bankrupt. People aren't going to make new loans because economic activity is starting to roll over, and that's why the Fed is going to probably be playing catch up over the next 12 months.
Yeah, and this is effectively a Fed funds rate chart, just for people who don't know. But when you overlay, let's say, the TNX to this, U.S. 10-year yield, you'll see an interesting story where last year they cut interest rates, but there really wasn't much movement on the 10-year yield. So you've got the 10-year yield here in red. I'm going to turn this into a line plot as well. You'll see when we cut interest rates back then, where is it? Back here, the 10-year did not respond. It actually went up a little bit.
Yeah, so the longer end of the curve is controlled by God, and I say that kind of tongue-in-cheek. The longer end of the yield curve responds to growth and inflation. And what we do know is that we're bullish on longer maturity treasuries for people with more speculative wherewithal, because once it's apparent to the markets that the rate of inflation is coming down, and we may get disinflation or deflation, and growth slows, that's when the long end really will respond. And the long end is starting to sniff this out. There still has been this, in the capital markets, there's still this belief that, yields are going to go up because we're going to go into some sort of financial debt crisis. We're nowhere near the end of our rope as other countries are. So we suspect as global growth slows and there's a growth scare, there'll be a flight to safety, as there usually is, and it'll be into the 10-year and the 30-year on an institutional basis. Institutions will sell equities and other risk assets and crowd into U.S. Treasuries. And also, let's not forget, if there is a problem with demand on the long end, we've never employed yield curve control. That's always a card we haven't done yet, at least explicitly done yield curve control. Japan did it for 20 years until it didn't work. So I think the U.S. is going to be seen as a flight to safety trade yet again. And the consensus out there is that the U.S. is doomed, the dollar's doomed, and yields are going higher. I don't believe that, especially as economic growth is gearing to roll over. We're seeing it in real time. We've got this K-shaped economy where seven stocks are holding up the stock market. The stock market's going to be late to the party on this one, as it usually is. Bond guys always know. And if you always look at the short end of the money markets, credit's getting tight, and three-month Treasury bills, which are the best pristine collateral out there, are getting a bid, and they're also sniffing out a Fed rate cut. So, there was I don't know if you remember this or saw this last week, but there was a mysterious shutdown of the CME due to coolant issues. That's just absurd. There was, and a lot of people figured this out. There was a silver squeeze trade going on. Someone demanded a tremendous amount of physical silver. There wasn't the silver, so we think that they shut down the CME so they could get time and negotiate with this person and figure out a way not to have to deliver that silver, because it would have blown up a lot of derivatives and there would have been contagion effect. So, I said on that Friday, watch the 3-month T-bill to tell you the truth. And then, of course, we open up Monday, Tuesday, Wednesday, the 3-month T-bill is ripping lower in yield. So there is something going on behind the curtain. Before we started this interview, you and I were talking about the repo that the Fed's extending to institutions. So there's a liquidity, a kind of a silent, non-media generated liquidity squeeze going on. People are chasing pristine collateral, and that's where we are. I mean, this reminds me a lot about what led up to the .com rollover and the great financial crisis. That the plumbing behind the system starts to have a liquidity problem that feeds its way back into the corporations and the consumer, and it's a feedback loop until the Fed responds.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video. Yeah, we saw a pretty big amount of Fed repo purchases just right before COVID here in 2020, to the tune of $61 billion on one period. I believe this is on a monthly period, so 1 month. We've spiked up quite a bit lately as well, but you'll notice that anytime we have these recessions, these gray bars here, we have repo buying at unprecedented rates right before it. Right, you saw it here in 2008, you saw it here in 2000, and you pretty much saw it through the entirety of 2000 to 2008. And of course, you saw it before COVID, and now you're seeing it again. Is this a case of where they're being smoke, they're also being fire?
Yeah, look, what we call it what's going on behind the curtain. And what we do know is that for the last 2 to 3 years, there's been this kicking the can down the road in the commercial real estate. And people were predicting commercial real estate would cause a banking crisis, and it kind of did in 2023. What they've been doing has been extending and pretending. There's about $3 trillion in commercial real estate loans on these banks' balance sheets. And I was talking to a guy yesterday who told me a story. He's a commercial real estate guy, and he had a loan in 2023 come due, and normally banks would refinance the loan. All right, especially if the property's cash flowing, and he was, but the bank wanted all its money back, and he was like, "Whoa, what do you mean? You want the loan paid in full? I don't have that cash available." And they said, "Oh no, don't worry about it. We'll give you 6 to 12 months." He eventually paid it off, but yeah, the bank told them, "We don't want any more exposure to commercial real estate." So there's been no lending in commercial real estate, and extending and pretending on the loans that are, some of them that are underwater because they don't want to expose the losses there. So that's just one part of the system that's been kicked the can down the road. Now we have private credit issues. So the longer you kick the can down the road, it gets to the point where you can't hide it anymore. And the repo market's telling you that's what's going on behind the scenes. There's a lot of pretending that we're solvent, but they're not. And so, as we roll through time, this is going to become a bigger and bigger issue. And as the economy actually does slow, that's when, those swimming naked will be seen. And, we suspect there'll be a bank consolidation phase. I thought it would have occurred earlier, but, the powers that be have been trying to pretend that this isn't going on. And it's kind of coming to a head.
A bank consolidation phase, meaning bigger banks buying smaller banks?
Yeah. There'll be marriages. There'll be sanctioned marriage. Look, if I was at the Federal Reserve or I forget the agency that monitors banks, the Federal Depository Insurance Corp, I'd already be aware of who might be in trouble and, lining up who I would call to help facilitate the purchases of it. Because what's going to happen is some regional bank will get into trouble. Jamie Dimon will get a call. They'll tell him you have to buy it. Then Jamie will negotiate to get the best deal possible for JP Morgan. And that's what happened in the great financial crisis. There were these shotgun marriages. I suspect we'll see a phase of that happening. And I don't, could be 12 months from now, but that's coming down the line. We're going to have fewer banks at the end of this than we do now.
Yeah, I mean, I'm looking up the FDIC's treasury amount, and it looks like it's what, $100 billion or so.
Yeah, that's not going to be enough. So
there's what, tens of trillions of dollars floating around in these banks.
Yeah,
reserves.
Yeah,
so,
and I mean, look, there's going to be. What I do know is there's going to be. I don't think it's going to be systemic like it was during. We almost had a systemic event during the great financial crisis. I think there's enough tools in the toolbox, but it's going to be very unpopular because as opposed to the great financial crisis, there's a certain cohort of the population that's more aware of how the system works, and populism is on the rise. So they're going to do what they normally do. They're going to print and spend. Our deficits are going to blow out in the recession, and there's going to be a lot of, quote unquote bailouts going on, and it's going to be very unpopular. So this crisis. I don't think it goes systemic.
There you are.
When did I leave?
Yeah, you were randomly kicked out, but you're back now. But you say you don't think it's going to go systemic, but.
Yeah, I don't think it's going to go systemic, but there'll be a lot of bailouts and deficit spending during this recession. The deficits will blow out as they usually do in a recession. The good news is that the trading imbalances will go down. The trade deficit will go down dramatically just because that usually happens in recessions. So that's on the good side. But there'll be a lot of bailouts. They'll be very unpopular. Unlike the great financial crisis, the populace is more aware of how the system works than they did in 2008, 2009. I mean, we had the Tea Party came into being after the bailouts of the banks then, and they did a good job of demonizing that movement and infiltrating it and kicking it all over the world. That turned into populism, and so unfortunately for Trump, he's going to be at the helm during this disaster, and he's going to be in the awkward position of trying to save the system and bailing out rich people, which is is going to cause a lot of, I don't know, I wouldn't say civil unrest, but a lot of political agitation.
Yeah, we'll get into Trump here in a second, but I want to take it back to what you said about the banks. Now, I've got a few bank accounts at some regional banks. Should I be worried about my deposits at these regional banks? Or should people who have regional bank accounts be wary of?
Well,
bank failure?
look, if they do shotgun marriages, you'll be fine. Your money, and if you have under the 250, you'll be fine. I'm not one of these people that wants to cause a bank run and tells people to take all their money out of the bank and stick it under their pillow. But if you got $12 million with a regional bank, you might want to think about diversifying that.
Understood. Well, let's take it to Trump here for a second. Approval ratings at a current term low. He did have lower approval ratings at some points in his first term, but in terms of where he's at today, pretty low approval ratings. He's been talking about ending the income tax in the not so distant future, quote unquote. He's talked about $2,000 stimmy checks. He's talked about 50-year mortgages. I mean, aren't they going to just throw everything in the kitchen sink at this thing, at least until the midterms, to keep it afloat?
Yeah, Bush did the same thing in 08. He floated stimmy checks too. I think this is bigger than $2,000 stimmy checks. This is unfortunately the culmination of several years of kicking the can down the road. It's coming to a head, and unfortunately, his messaging. Look, I think long term, we need these trade negotiations because there's an imbalance in the world. And China is exporting deflation, which would wreck most every other consumer economy, jobs-wise. So, I think he's got the right idea. The problem is it doesn't take and hold and create economic growth in the U.S. for years. So there's this valley before, the quote unquote his golden age. But he's talking about we have a golden age now, which is a complete farce. It's the wrong messaging. It's insulting to the middle class because they don't feel like this is a golden age. In fact, it's getting incrementally worse for them. Yes, inflation peaked under Biden, and the rate of inflation is dropping, but prices are nowhere near where they were pre-COVID. And we have the global growth economy slowing. We're starting to see massive layoffs beginning in some of these corporations. They're claiming it's AI layoffs. I don't think that's true. I think AI is a problem for jobs down the road, but not right now. I think that's a good way to excuse a bad economy. And Trump's messaging and the administration messaging is all wrong. When they talk about 50-year mortgages, that's a signal that they're trying to support home prices. That's not going to work. Affordability is the biggest key to home prices right now. The buyers can't afford to buy. And we've never seen, in our real estate report that we issued in August, one of the most stunning graphs was two time series. One was homes for sale and one was homes sold. The spread between those two time series is like this. Usually they kind of track each other over time, but now we have this huge gap. And so what's the only way that's going to close? That's price. And prices are starting to roll over. We're seeing new permitting peaked in 22. That's going the wrong way. Speculative homes sold before construction, meaning very speculative buys, have been plummeting. These statistically have been leading indicators for a slowing and rolling over housing market. And now we're just waiting for construction to roll over as the homes that are in the pipeline get built, and that's starting to come to an end. There's no new ground being broken because there's not this shortage of homes. There's a shortage of buyers. That's the problem right now.
He also talked about ending the income tax. Is that a feasible proposition?
No, I don't think that's going to happen. I mean, that's I think that's midterm political speak. There's no way you could shut off the income tax and fund the government under the current regime, the current system we have. You'd have to you'd have to reduce the size of government dramatically to get rid of income taxes.
Yeah, which is not what they're doing.
No.
Well, Ed, I'm going to ask this question to every one of my guests up until the end of the year. But, since we are coming to the close of the year, and this is probably the last time you and I chat for this calendar year at least, I want to get your take on what you think would be 2 or 3 big predictions for 2026. I mean, I'm not going to hold you to these predictions, but, some of the predictions or some of the forecasts that you have, maybe you haven't gone public with them yet, maybe you have, I don't know, but if you were to make 2 or 3 big predictions for 2026, what would they be?
One, China will be coming into the spotlight more and more because of their economic woes. As we believe their crisis accelerates into 2026. So you're going to hear more about China. The Fed at some point is going to realize that they're really behind the curve. So there'll be some sort of spectacular, over the weekend meeting and emergency rate cuts at some point in 2026. And then finally, I think the AI bubble may have popped, but I suspect, and unfortunately for Trump and the administration, they're going to try to continue to prop that up with some sort of government, whether it's equity investment or some sort of aid to the AI companies. That might give one more blow off top to the AI companies, but if that happens, you can short the hell out of everything. It's over after the massive pop.
What are some of the key signals that you would look for a pop?
Well, like David Sachs is out signaling, he came out and denied they would do a government bailout, but then he said, oh, the economy is being held up by AI data center spend. We can't go into a recession, which, is a signal that maybe the government's going to get involved. So, I think to the detriment of the Trump administration, you don't bail out an industry at the top, and that would be the clear ending signal for me that the AI bubble is finally burst, is government assistance.
Wow. Well, Ed, I know we don't have much time left, but if there's anything else you'd like to talk about before we wrap this thing up and take it home, feel free to do so.
I'm just stunned at the messaging from the Trump administration. They seem to not be getting good advice. They should have understood that they inherited they did a little bit in the beginning of their administration talk about inheriting a turd from the Biden administration. And I think they now are claiming victory on the economy, and this is all going to bite them in the butt going forward into the midterms, because it seems to me that we're going to have serious perturbations in the financial markets and the economy going into the midterms. I don't think there's anything that they might try to 50-year mortgages and stimmy checks. I don't think what's coming can be stopped, unfortunately.
And the Biden team did the same thing. They declared victory when the economy was clearly not in good shape either. So it's a failed play from the Biden playbook that they're running.
Well, what I think is lost on a lot of people, and the elephant in the room, is what really juiced the economy in 23 and 24 was illegal immigration. When you bring in 20 million people and give them money that, typically speaking, never had any, what did they do? They injected right back into the economy, lickety split, and that went straight to the corporations' bottom line. A lot of our corporations were the beneficiaries of this illegal immigration operation and kept the economy going.
I see. Well, interesting chat as always, my friend. I hope you have a happy holiday, Merry Christmas, Happy New Year, all that jazz. Where can people find you if they want to see more of your work?
Yep, you can find us at financetechnologies.com with the PH. We have research available for purchase. You can also follow me on X at Dowd Edward, and on Getter, Edward Dowd. And also I have a private website, eddowd.com, you might want to visit.
Okay. We'll have the links to all that down below, so check them all out, guys. And if you got value out of this podcast, again, hit that like and subscribe. It does go a long way in helping push this video, this channel, and this message in the algorithm. And first and foremost, it's free. Everyone's favorite 4-letter F word. So doesn't it doesn't hurt. It helps the channel. But if you'd like to support us even further monetarily, consider becoming a member at the Substack at capitalcosm.substack.com. Get access to all of my stuff early, ad-free, and uncensored. So with all that said, I'll catch you guys next time. Thanks for watching. Bye.